Welcome to Real Finance, your number one place for financial education. Sorry my robotic sister Amy had to cover while I was under the weather, but I'm all ready to get your financial education going. Today, we will go a little deeper into understanding how companies are valued and some of the basics of how we can value a company that we want to invest in. Just as you wouldn't want to buy a car without knowing how many miles are on it, its accident history, and general maintenance history over its lifetime, the same should apply to a company that you invest in. While there is no magic formula for picking the right company, a good place to start is a company's balance sheet. You can find most publicly traded company balance sheets on sec.gov, or you can sign up to Investopedia and search most companies, and they will have their fundamentals already listed. On the SEC website, it is better to pull the 10K report, which gives fundamental data of the company for the entire fiscal year, while the 10Q gives reports for the fiscal quarter. Generally, the longer historical data you have, the better, so I recommend using the 10K report. The big metrics that most analysts use are the price to earnings ratio, price to book ratio, debt to equity ratio, free cash flow, and price to earnings to growth ratio. These terms can seem daunting at first, but let's break down the PE ratio. Price to earnings ratio. This is the stock price over the net earnings per share of the entire year or quarter, depending on which report you look at. This is a useful tool for a starting point to measure if a company's stock price accurately represents the earnings per share. From here, we can make a good assumption as to if the stock is overvalued or undervalued. But this value should be taken with a grain of salt because it makes assumptions of what investors are willing to pay for expected higher earnings. For example, if stock XYZ is trading at 100 today and they reported a profit of 10 billion for the previous fiscal year, if they still have 2 billion shares outstanding, that means that their earnings per share is $5. If you take the price $100 over the earnings per share $5, this tells you that investors are willing to pay 20 times the current share value. Or to put it more simply, they believe that $1 of the company's earning now is worth $20 of their earnings later. It is important to note the main primary limitation of this value metric. Companies throughout different sectors have different ways of making earnings and do so along different timelines. So while the PE ratio is a good tool, it is more powerful when comparing companies in the same sector such as energy. However, comparing a company's PE ratio in the energy sector versus a company in the consumer goods sector is not a reliable assumption of value. So now that we have a good understanding of this value metric, it is important to know it is by far not the only one. Remember to subscribe to our channel to start taking your financial health into your own hands. Stay tuned for our next episode where we will dive further into real finance.